to another session of the Rousseau Report. I'm your host, Dennis Rousseau. Over the last year, I've drawn corollaries between global economic data and business jet sales and values. And I'd like to provide you a brief update on where we are as of the end of February 2023. First off, let's look at some economic fundamentals. Box shipments are down year over year, which translates to low demand for packaging material, which directly parlays into reduced consumer spending, and that in turn affects the manufacturer, and if you're not making boxes, you lay people off. I'll get to that in a minute. Industries that saw demand during the pandemic are now crashing. Container shipping, car sales, which we'll circle back to, home building are all in a downturn, and after an uptick, this shouldn't surprise anyone. However, remember this point, an increase in supply will drive down prices. The Strategic Petroleum Reserve is 40% lower than when the current administration took office, the lowest level since 1983. You can't sell millions of barrels of oil to the China Petrochemical Corporation, stop all domestic drilling and exploration, and on top of it expect gas prices to go lower. Utter stupidity. Total outstanding credit card balances are at an all-time high, just under $1 trillion. When do we witness high credit card balances? Certainly not during normal times. How are we doing in the CPI arena? From 2006 through 2020, over 14 years, we would see an average 1.8%. Look what we have now. And mind you, it does not include food and energy. To the consumer, what else is there? We're well over 25%. Home purchase applications fell this month to their lowest level in 28 years due to high interest rates, inflation, and steep home prices, which have increased year over year for 131 consecutive months, the longest stream on record. Banks are tightening lending standards because defaults are on the rise, and this is all reflected in home sales. The government told us a couple of weeks ago that the U.S. economy added 517,000 jobs in January. That's not actually what happened. The raw unadjusted numbers showed that we lost 2.5 million jobs last month. That's a horrible number. But after the administration gets done with their adjustments, it magically becomes a gain of 517,000. You can't misrepresent the economic reality with such a false narrative. Job cuts, meaning layoffs, firings, are up 440% from a year ago. These facts are compiled since January, 2 months, and look at the number of layoffs. Amazon, 18,000. Federal Express, 12,000. Microsoft, 11,000. Wells Fargo just cut 500 from their mortgage lending business. These companies are all across the board: consulting, manufacturing, retail, technology, energy. Business investment grew at a mere 1.4% in Q4, which is mostly inventory growth. Non-residential investment, a key driver of future economic growth, was up 0.7%. Residential investment dropped 27% as consumers are unable to afford the combination of high home prices and interest rates and falling incomes. The growth in inventories, accounting for half the GDP growth in Q4, is not a good sign. It's the result of businesses being unable to sell off inventories at current prices and liquidating at discounts, which will mean lower profits. Real disposable income fell $1 trillion in 2022, the second largest drop since 1932. The number of high-rise building owners are defaulting on their loans. Brookfield Asset Management just defaulted on over $750 million for twin 52-story towers in Los Angeles. Another real estate firm, RXR, is in talks to restructure debt on 61 Broadway, a 34-story tower in Manhattan's financial district. Turning the building over to the lender has never been a good sign. Vacant office space throughout the U.S. is out of control and is expected to top 1 billion square feet, up from 680 million in 2019. Toyota plans to increase production this year, turning out 10.6 million cars for 2023, compared to the 9 million cars made in 2019. But wait a minute. Do you remember last year? This car dealer is looking at his empty lot in June of 22. And now February 2023, he has more cars than he knows what to do with. Average new vehicle price is up to $47,000 in 23, from $32,000 3 years ago. Yes, overall sales tanked in 2020, and the expectation is we're going to see an increase in sales this year. That's a tough one. Inventory may be on the rise, but when you consider the base price of a Jeep of $55,000, who can afford to buy one? How does all this parlay into business jet markets? Let's return to the Great Recession. Aircraft added to the market are shown on top and transactions are shown on the bottom. Our transactions are down 30% while inventory is on the rise. The dismal number of transactions for January-February 2023, ouch. Let's look at a very popular model, the G550, 2013 year of manufacture. Yes, it had an increase in selling price since 2019. The same thing that happened in 2008. Inventory and days on the market are on the increase. So as not to pick on a particular model, let's look at aircraft in the small jet category. Days on the market, up. Percentage of the fleet that sold, down. The super midsize category shows similar results, as does the ultra long range category. And when you see inventory on the rise, remember, an increase in supply drives down prices. The fly-by-wire G500 is a very capable long-range business jet with state-of-the-art avionics and engines. 12 aircraft representing 11% of the fleet are on the market with 0 sales year to date. I like to look at trends. What happens over time on the pre-owned market as well as new deliveries? Since 2015, the G550 pre-owned markets have averaged over 10% of the fleet on the market in any given year. Over this time, we've seen an increase in days on the market, and the average days on the market to sell is on the rise. We're in for some very interesting times. Thank you for tuning in. I'm Dennis Rousseau for the Rousseau Report.